Hello, everyone. Welcome to today's accounting design project. Today we have Katie Lam from Ohio State University and then Simi Mukherjee from Washington and Lee University to talk about goodwill impairment. Okay, so Katie, the floor is yours.
Cool. Thanks, Young. We are really excited to talk to you guys today about step 0, reliance on the qualitative goodwill impairment assessment. And this is co-authored work with two of my good friends from the PhD program, Catherine Adame and Samin Mukherjee. So the research question that we asked in this paper is, do managers rely on the qualitative goodwill assessment in a manner consistent with the intent of the FASB? So where I want to start is just by talking a little bit about reliance on the qualitative goodwill assessment. So this is what goodwill impairment testing used to look like before the qualitative option was available. So in step 1 of impairment testing, managers would calculate the fair value of the reporting unit and compare it to its carrying value. If the calculated fair value exceeded its carrying value, then there would be no impairment. If not, then they would proceed to another step and record the impairment. In 2011, the FASB added a step before this, which is the qualitative assessment. So step 0 asks managers whether it is more likely than not that the fair value of the reporting unit exceeds its carrying value. So still thinking about fair value and carrying value here, but now just whether it's more likely than not, and making this determination using qualitative factors. Okay, so if the answer here is yes, it's more likely than not that fair value is greater than carrying value, then there's no impairment, they're done. If the answer is no, then they would proceed to step 1, which is the traditional quantitative calculation of fair value. And we're interested in reliance on the qualitative assessment, meaning that they only use step 0 to reach the no impairment conclusion. So we're interested in how managers are using this qualitative assessment, whether it's consistent with the intent of the FASB. So what is the intent of the FASB? When the FASB introduced the qualitative option, the goal was to essentially reduce the cost and complexity of impairment testing, but without, of course, without eroding the quality of reported goodwill. Okay, so we try to tackle this research question in 2 parts. First, by looking at reliance on the qualitative assessment when a quantitative test appears necessary. Okay, and then second, by looking at reliance on the quantitative test when a qualitative assessment appears sufficient. So this first part really tries to get at whether the quality of goodwill has been eroded by looking at managers relying on the qualitative assessment, essentially when it looks like they shouldn't be. Okay, and the second part tries to get at whether the qualitative option has really reduced the cost and complexity of impairment testing by looking at managers who don't use it at all, even when they could. Okay, so what does this look like in practice? This is an example that we built from TripAdvisor's disclosures, and they sort of follow the practical guidance from the firms and the FASB here in their consideration. So they say they use the qualitative assessment, and as part of that, they consider factors including the macroeconomic and regulatory conditions. They think about what is going on in their industry at that time, if they need to access more capital, their ability to do that. And then they think about whether there have been any major changes in leadership, so in their organization. Okay? And based on those factors, they conclude it's more likely than not goodwill is not impaired. So they are done for the year. In contrast, the quantitative test, it requires an actual calculation of fair value of the reporting unit. So one way that companies can do this is by using a discounted cash flow model. So this is just an example we built from Arconic, a manufacturing company's disclosure, and they say they use a DCF. And in their disclosure, they say, you know, there are significant assumptions and estimates that are involved in this. So we have to think about how much our demand is going to grow and what our capital expenditures are going to be. And we also have to come up with a discount rate. Okay, and so sometimes we'll consult a valuation expert for that. So the quantitative test is a bit more involved. Okay, so why do we care about this research question? Well, we know that goodwill is economically meaningful. So during our sample period, almost half of firms have goodwill. And for these firms, goodwill represents on average 15% of total assets. So we care about the discretion that managers have in reporting goodwill. And when the FASB was working on this amendment initially, there was a lot of debate over whether introducing a qualitative option would essentially be good or bad. So these quotes are from comment letters that were submitted during the exposure draft period. And there were a lot of firms like FedEx that strongly advocated for a less costly impairment testing option. So saying things like, the quantitative test, it requires the commitment of a lot of resources. But the FASB was aware of this concern that the qualitative approach potentially could be not rigorous enough, that it would essentially just delay the recognition of impairment losses. So we try to shed light on how these trade-offs play out. We think this is particularly important given that we find reliance on the qualitative assessment has increased quite a bit over time. So when it first became available in 2011, only about 15% of firms relied on it. But since then, that amount has more than doubled. So by the end of 2019, about a third of firms relied on the qualitative assessment in their annual impairment test. Prior research has looked at a lot at FAS 142 when we switched from amortizing goodwill to just impairment testing using this unverifiable estimate of fair value. And these papers look at whether the discretion that is given in this unverifiable estimate of fair value is exercised in a manner that's consistent with managers' private information about what goodwill is actually worth, or in a manner consistent with agency-based motives. And they found that FAS 142 resulted in less timely impairments. Okay. I should say that there is a recent paper by Beatty, Lau, and Weber that kind of provides mixed evidence. So they find no evidence of inflated goodwill balances compared to definite lived intangibles, which are still amortized. But these papers also find that there are a bunch of different incentives that impact impairment recognition. And while FAS 142 granted managers the ability to use this unverifiable estimate, the qualitative assessment essentially gives them the option to forego that estimate entirely. And the qualitative assessment is completely optional. Managers can just stick with what they were doing before. So it's not clear whether the results from this line of literature extends to the current standard. There is a recent paper on the qualitative assessment by Black, Krupa, and Minuti Meza, and they find that firms that use the qualitative assessment in the first few years after it became available had a higher incidence of impairments in the current year. So what we learned from that is that on average, starting your impairment test with the qualitative option, it doesn't allow you automatically to just reach the no impairment conclusion. So some firms still do proceed to step one and ultimately recognize an impairment. What we still sort of don't know is for the firms that did avoid impairment in the current year, did they do so appropriately or not? And then what can we say about the firms that don't use a qualitative assessment, even though they could have? Okay, so our first hypothesis looks at reliance on the qualitative assessment when a quantitative test appears necessary. So how do managers use the qualitative assessment when it looks like they maybe shouldn't be? Do they use it in a way that reflects their private information about the value of goodwill? Or do they use it strategically, potentially to delay impairment recognition? Our first hypothesis is stated in the null. So in other words, managers do not strategically rely on the qualitative goodwill assessment. So they use it essentially how the FASB intended. When their private information indicates they're far away from impairment, and there's no need to even go through the quantitative test to calculate fair value. Given that reliance on the qualitative assessment has increased significantly over time, we also look at whether managers rely on it differently over time, either more appropriately as there's sort of been more guidance that's come out and they figured out best practices, or potentially more strategically as firms have figured out exactly what auditors are looking for and could potentially take advantage of that. And then in H1B, we also look at whether managers rely on the qualitative assessment strategically, more so when they have both incentive and opportunity to delay impairment. So we know that reporting strategically, it's not costless. So incentives and opportunity are likely to play an important role. Yeah, Ayaan?
Hi, Katie. I have a question about, I think here you frame your hypothesis as whether they actually report strategically, but I think empirically, it's kind of a very challenging task to measure it. I wonder that you can kind of like think about your hypothesis as that whether they use qualitative assessment or not will actually change the timeliness of their goodwill impairment that is observable to external users. Because that essentially is going to actually have an impact on the investors and the user financial statements in terms of investment decisions, regardless whether managers have been strategic or not, right? You can be a manager who strategically take advantage of this step zero, but potentially the timeliness of the goodwill impairment appear to publicly still similar to a scenario when you actually do not strategically utilize this assessment. So I try to kind of like think about what exactly is the decision usefulness and the alternate decisions that could have happened as a counterfactual if managers are not strategic. Like, why do you need to focus on strategic? Why don't you actually just focus on the outcome that all of us can observe, like the users?
Yeah, okay. That's fair. So maybe if we could take it a step back and just say, like, does it delay impairment recognition
Yeah.
rather than are they using it strategically to delay impairment recognition?
Yeah, because if there's no change in the timing of the impairment as an investor, do I really care about that is strategic or not?
Yeah.
Because the timing is still the same. It's just like the process leading to that timing differs, but how much do I care about the process actually is different? If
Yeah.
the timing is similar or identical.
I take your point. I think that in the, when we get to the research design, I think that we do try to show that essentially the timing is different, that when they rely on the qualitative assessment, that those are effectively delayed impairments. Okay. Okay, so to tackle this question, we actually go out and read firms' disclosures in their 10Ks and manually classify which method managers relied upon in the current year. And we do this because the language varies a lot in the disclosure, so it's hard to sort of do this in a machine readable way. We do this hand collection for 13,000 firm years between 2011 and 2019. And in about 3,000 of these firm years, we cannot tell from the disclosure which method they ultimately relied upon at the end of the day. For 730 of them, they rely on both methods just across different reporting units in that same year. And so we toss those out from our primary test because our outcomes are at the firm year level. And so we want to be able to tie them to a specific method. So our primary sample consists of the last two buckets, the 2,400 firm years in which they rely on a qualitative assessment across all reporting units that year, and then 6,900 firm years in which they rely on a quantitative test across all reporting units for that year. Just to give you guys a couple of examples of the disclosures, this is from Norwegian Cruise Lines. They say, as of December 31st, our annual review consisting of the step zero test supports the carrying value of these assets. So we take step zero test here and infer the qualitative assessment. So we code our primary independent variable qual equal to 1. Here's an example of a firm year in which they rely on the quantitative test. So they don't use specifically the language quantitative, but they say that they estimate the fair value of the reporting unit using these common approaches for doing so, the market approach and the income approach. And then in the last sentence, they actually say, this is how much cushion we have between the fair value of each reporting unit and their carrying value. Okay, so we infer from this that they relied on the quantitative test. They actually went through the calculation, and we code our variable of interest qual here equal to 0. Okay, so to test hypothesis 1, which explores whether managers rely on the qualitative assessment in a manner consistent with the intent of the FASB, when it looks like they should be doing a quantitative test, we look at the relation between reliance on the qualitative assessment and the likelihood of future impairments. So if managers rely on the qualitative assessment in a manner consistent with their private information about the value of goodwill, then we expect that reliance on the qualitative assessment has a negative relation with future impairments. In other words, they only rely on the qualitative assessment when they're so far away from impairment that they don't even need to go to that step to calculating fair value, right? The impairment test is a slam dunk. If they rely on the qualitative assessment strategically, or maybe just here to delay impairment, then they may be able to avoid impairment this year. But assuming that impairments can't be delayed indefinitely, then we would expect that they're more likely to recognize an impairment over the next 4 years. So we would observe a positive relation between reliance on the qualitative assessment and their future impairments. So to implement this,
can change, right?
sorry, can you say that again?
They said things may change in the next 4 years.
Sure, yeah, things could change, certainly. But I guess to the extent that things change in those next few years, we don't expect that those are systematically correlated with the testing method they relied upon this year.
Yeah, I think, Katie, so there's a paper published in Journal of Financial Reporting by Jake Thomas and James Potepa. So they kind of introduced a new approach to assess the timeliness of goodwill impairment. So their approach is actually at the transaction acquisition level, right? Because I think alluded to kind of what Joshua talked about is that potentially from year T, firms may have more acquisitions and the composition of that pool just change over time from year T to T+4. But if you hold constant particular transaction, for example, Microsoft acquired Aviation Blizzard in 2023, and whether they use qualitative or quantitative assessment for that particular past transaction allows us to actually predict the timeliness of the goodwill impairment regarding that transaction. So at the transaction level, impairment timeliness assessments, you kind of like account for the changing composition of the acquisitions at a given point in time for publisher.
Yeah, I think that's, so that paper by Potepa and Thomas, they have this really cool data where they track everything at the acquisition level, so it goes back to the acquisition level and they see how that evolves over time. They were actually nice enough to share that data with us for some of our tests, but the overlap in terms of our sample is very limited. So we couldn't use it for our primary tests. But yes, I think like it's great if we could get at the acquisition level, then we have that data. But what we observe at the firm year level, it's analogous to what the market sees, right? Now the market could, track things at the acquisition level and keep track of that on their own. But in terms of the information that's available in the financial statements, it's at this level. Okay, so to implement this test, we regress an indicator for whether the firm impairs in the next 4 years on our variable of interest qual, and we include a bunch of controls related to the likelihood of impairments based on prior literature. And we identify firm years in which a quantitative test appears necessary based on this broad indicator of impairment. So when they don't have a market value cushion. So we code this variable no cushion equal to 1 if the value of goodwill exceeds the cushion between market value of equity and book value of equity. And so we say this is when it looks like they should be doing a quantitative test. So if reliance on the qualitative assessment is consistent with managers' private information that they're far away from impairment, then we expect this beta 1 coefficient to be negative. And if reliance on the qualitative assessment is just a delay impairment, then we expect that this beta 1 coefficient is positive.
Maybe I think there's a question in the chat box by Jennifer Chen. Jennifer, do you want to ask your question verbal?
I would just follow up the earlier discussion, like how frequent you observe firm change between your variable qualitative equal to 1 versus 0?
Yeah. Most firms do rely on both methods at some point during the sample. The vast majority of them do. And I would say that on average, firms are doing the quantitative test at least once every 3 years.
Okay, at least once a week. So like they change about like every 3 years?
Yeah, so that's part of the reason why we would expect that any potentially delayed impairments are going to ultimately have to be realized within the next 4 years. Because in practice, right, they don't just rely on the qualitative assessment and then do that. It's not like there are qualitative firms and there are quantitative firms. Most firms do both methods, and a lot of firms actually have a policy of we have to do the quantitative test once every so often.
Okay, interesting. Thank you.
So Katie, can I have a follow-up? I think another way to ask Jennifer's question is in your empirical model, are you able to estimate your beta one after you include firm fixed effect? Because if firms actually do not change their assessment between qualitative and quantitative frequent enough, after you include firm fixed effect, then you probably are not able to estimate beta one with kind of sufficient statistical significance because they don't switch very often.
So maybe I'm jumping ahead to the results, but I think that like eventually we do find that for a subset of firms, these impairments are ultimately recognized, which implies that they do end up switching. We haven't estimated it with firm fixed effects because I think we're not sure that there isn't some like time invariant firm characteristic that we're trying to control for. So I think that this idea that the situations in which they rely on qual are the situations in which impairments either don't play out in the future or do if they're strategic, then that is what we're after. I don't know if that answers the question.
Yeah, I think the reason I'm curious about it is I want to know whether this choice is a firm level policy across across all the different compositions of acquisitions, or is it actually kind of like acquisition specific choice? So I think having that would allowed us to kind of think about the level of the decisions that within the firm that is not observable to us.
Okay.
Benefits,
Okay.
yeah, that's whether they always can adopt a persistent policy regardless of the past acquisitions they already have in their portfolio versus it's contingent on the nature of the acquisitions they have in their portfolio.
Okay. Yeah, we can look at that. We can look at that a little bit more closely, looking at their patterns and sort of how they evolve over time. We've looked sort of high level at like how many years do they go without switching, but we haven't looked at necessarily like do they implement a policy and then they never change it. We've sort of just looked at to make sure that there is variation within firm.
Or whether they change right after a very significant acquisition relative to their total size or something. That would be something interesting to kind of get into the black box about how they actually made that decision. And we can only infer externally, but I can try to play with all those different specifications will actually shed light more on what actually happened within the firm.
Okay, yeah, that's interesting.
Yeah, I think that's very interesting. I think this is not really gonna hurt your paper. I think this is gonna, even if it's to some degree it's a firm policy, it's still very interesting, right? Is that firm policy what the FASB wanted to be, right? Is that a policy informative or is they're manipulating it?
Yeah, okay. And then so when we have these new acquisitions, do they potentially change what they were doing before? Yeah, that's interesting. We can dig into some of that. Thanks. Okay, so before we actually test this H1, we start by just establishing a baseline for the relation between reliance on the qualitative assessment and future impairments within firm years that have a market value cushion. So when it looks like, okay, they should be doing the qualitative assessment essentially. So these are no cushion equals 0 firm years. And here we find that reliance on the qualitative assessment is associated with a lower likelihood of future impairments. So managers that rely on the qualitative test, they not only do they not impair this year, they're less likely to have impairments over the next 4 years, which is consistent with them doing so when their private information indicates that they're far away from impairment. So then when we look at firm years in which it looks like they should be doing a quantitative test, so within no cushion equals 1 firm years, then we find that this negative relation, it weakens in the 2-year window and actually disappears over the 4-year window. So while there isn't evidence of strategic reliance on the qualitative assessment here to delay impairment, this sort of weaker relation in these firm years when it looks like they should be doing the quantitative test tells us that managers don't exclusively rely on the qualitative test when they're far away from impairments. There are some other conditions under which they're also relying on the qualitative assessment. Okay, next we see whether these implications for future impairments have changed over time. Yes, Jennifer?
So just curious, the slides you showed earlier, does auditors use those cushion measurements when they're looking at firms to evaluate whether they should take impairment or they're testing? Is that something known that they're doing? I don't know what they do, but I'm just curious.
Yeah, so we did talk to auditors and they essentially said that like they're not involved in the process of initially determining which method managers rely upon, but they do come in after the fact and make sure that they're relying on, they're only relying on qualitative assessment when they should be. But in terms of the actual audit process, I think, for auditing the qualitative assessment, they're going to essentially have to prepare a memo that says, here are all the factors that they considered and how they reached that no impairment conclusion. And then auditors will go in and test the things that they said in the memo. So if they reference these indicators, then they would be tying out those calculations and doing like stress testing and things like that.
Okay, so sounds like this would not be something by the, it seems like it's not influenced by the auditors. Then what about the CFOs? Do they say, commonly this is what they do as part of the way they make the choice? I mean, did you guys talk to anyone?
You mean in terms of our no cushion variable?
Yeah, do they use that as a way to evaluate what kind of choice they should make?
Yeah, I mean, I think that, they do consider their market value, and that is also in the guidance by the FASB as well. Like a depressed market value is one consideration that they should have in testing. This variable, various market to book thresholds are very common in this literature as an indicator of impairment risk, essentially.
Right. I guess some level I was wondering, are we surprised by the results or not really? I don't know.
Are we surprised or are we not?
Yeah, that's what I'm trying to think about it. If this they told to do and it's a very observable variable, if not they're not doing it, they're gonna get caught. I'm just trying to think about what the implication is.
Yeah, so I think that's fair. I think that if we had, so here we try to identify scenarios in which a quantitative assessment appears necessary. And if we had this ideal variable, if we could perfectly identify when they should be doing a quantitative test, then the fact that in those scenarios we observe reliance on the qualitative assessment at all would be consistent with them using it opportunistically, right? Then we're saying for sure, we know, look, they're using it when they shouldn't be. But it's kind of because when a quantitative test is truly necessary is something that's really difficult to measure.
Yeah.
I'm sorry, I have another question and I'm not sure about the rules, but the impairments are on a unit basis, not on the, right?
Yeah, the reporting unit level. Mm-hmm.
Right. So it could very well be that the firm has a very large cushion and the qualitative test would pass, but it would have an impairment later on when in future years when some conditions at the reporting unit force them to recognize goodwill impairment. for that particular reporting.
Yes, I think that's fair.
So I'm not sure about, again, going through T+1 to T+4 and looking to see if there are impairments, if it says anything about the quality of the qualitative test that they did.
Okay. So a couple things here. I guess the reason that we think that we can say something about the qualitative assessment here is because in the Windows T+1 to T+4, yes, things can change, but we wouldn't necessarily expect that those things that change, maybe let's just call them exogenous changes, are correlated with this year's testing method. So we would expect that things could change for qual firms and things could also change for quant firms. So if things just change and they have to recognize impairments, yes, we think that happens, but that shouldn't be correlated with what they did this year. I think you're still not convinced. So, okay.
Katie, if allow me, I think, Joshua, I think you're alluded to is like after year T, somehow there are new acquisitions or changes in the business nature from year T+1 to future years.
No, it could very well be that you purchased a company, you acquired a company that sounded like it was extremely good, except that a year later, Trump comes and says that Tylenol causes autism, and that acquisition backfired on you, and all of a sudden you have to write down your goodwill. That's what I meant. And you couldn't know it at the time that you did the qualitative testing.
Yeah, and I think that what we're saying is that that could also happen to a firm that did quant this year.
Absolutely, yeah.
Yeah,
And
and
so
you cannot assume they are parallel throughout this 5-year window. That seems to be a very, very strong assumption. Yeah. Right, assuming that the business environment and acquisition frequency and nature of acquisitions are identical between these two firms that they chose quantitative versus qualitative in a historical year T. Or at least you can validate it to see if they actually different in terms of all those different dimensions from year T+1 to year T+4. But like right now, you kind of have that strong assumption without any other validations or I think it is just a very strong assumption that you're defending, and that's sometimes it's hard kind of to believe they are all parallel.
So if we
All else
wanted,
equal.
so essentially like in the year T, right, we have firms that we already condition on this no cushion variable. So this one indicator of risk. And then we also require that quantitative firms aren't recognizing impairments that year because qualitative firms by construction don't recognize impairments that year. So they're equal along those dimensions. So like ideally, what would you want to see beyond that?
Well, you can check from year T+1 to year T+4 whether the frequency of acquisitions are similar between those two groups.
Okay.
The newly added goodwill amount relative to size, say total assets, is also similar across two groups.
Okay.
Whether those are related, the nature of the acquisition, whether those are related, industry acquisitions or unrelated, there's a very significant M&A literature for you to actually get at the nature of the acquisitions, somehow could tide with how likely the scenario Joshua mentioned that maybe there's a new acquisition in year T+1 actually triggered a year T+2 goodwill impairment because that is very risky acquisition that they have to impair immediately. So I think there's a lot of things you can kind of like validate to kind of convince us that, well, they are still all else equal, only different in year T, historical year T choice.
Okay. This is helpful. Yeah, we can look at if there are new acquisitions because we know from prior literature that like acquisitions tend to impair Right, soon after they're put on the books, yeah, okay. Okay, we can look into some of this, thank you.
Yeah, one thing related to that is there's a literature called killer innovation. Is that companies buy another innovative firm and then just kill it right away. Usually it's within 1 year. So like impairment just happen right after the acquisition. They just want to kill the competition. Yeah.
Okay, thank you. Jennifer, is there still a question?
No, sorry, I forgot to turn it down.
Okay, I just want to check. Okay, so next we look to see whether these implications for future impairments have changed over time. So here we had a time trend variable to our regression. It equals 0 for the first year in our sample, 1 for the next year, so on and so forth. And we interact that with our qual. So beta 3 is the variable of interest here, and the null hypothesis that reliance on the qualitative assessment hasn't changed over time predicts that this variable would be 0. So here we find a positive coefficient on the interaction term, which is consistent with reliance on the qualitative assessment sort of becoming less appropriate over time. So in the earliest period, they only used the qualitative assessment when they were really far away from impairment. It was a slam dunk. And over time, it looks like they've sort of expanded the circumstances under which they rely on the qualitative assessment. Okay, so far we've established that when it looks like a qualitative assessment is sufficient, reliance on it is a signal that the firm has a lower likelihood of impairment risk going forward. This is less true when it looks like they should be doing a quantitative test, and less true over time. So next we look at the role of incentives and monitoring. So we modify this same equation again to include proxies for specific incentives to delay impairment and strong monitoring, okay? So for incentives to delay impairment, we look at an imminent equity issuance and the percentage of transient investors. And then for strong monitoring, we look at an industry specialist auditor and their analyst following. Okay, so prior literature has shown that both of these things can enforce impairment recognition. So the coefficient of interest here is actually the combined coefficient on qual and the interaction between qual and the incentive. So reliance on the qualitative assessment when incentives to delay impairment are present, but strong monitoring is absent. And if under these conditions, reliance on the qualitative assessment is strategic in order to delay impairment, then we expect this combined coefficient to be positive. So here in the first 3 columns, we're looking at imminent equity issuance as the incentive. And then in the last 3 columns, the percentage of transient investors as the incentive. Yeah, Ayang?
Do you want to finish this discussion so I can ask? Yeah.
Sure, I can. For each of these incentives, we just include the incentive by itself first, and then we layer in the specialist auditor or the large analyst following. And so across both of these incentives, we do find some evidence that the combination of the coefficient on qual and then the interaction between qual and the incentive variable is positive. So managers with incentives to delay impairment and weak monitoring that rely on the qualitative assessment, they don't impair this year because they've relied on the qualitative assessment, but they're more likely to have to recognize those future impairments in the near future. So this is consistent with them strategically relying on the qualitative assessment, or maybe if we want to tone it down, that the impairments are delayed using the qualitative assessment.
So my question is related to the previous slide when you showed us the empirical model. I've been thinking about that your fixed effect structure. So I think here you try to predict whether future impairment will actually occur in year T+1 to T plus N. But here, I think your year fixed effect is actually year T, right? The time when you decide whether you want to use qualitative or quantitative assessment.
Yes, I think that's true. Yeah.
So I think there's a potential specification you can track, because when you actually are predicting whether impairment is going to occur in a future year, there's a literature on like industry contagion, like when some industry member firms are in financial or operational distress, that then tend to kind of like has a contagion effect that everybody else also potentially are writing down their assets, and then that's related to your industry auditor kind of like partition. So one thing I would like to see is if the year fixed effect is actually tied with the impairment year. So you want the impairment year fixed effect, not the quantitative choice year fixed effect. So because you try to predict which year the impairment is going to occur. So like here, you probably cannot have a cumulative 4 or 5 years of impairment. You may have individual years, and then year fixed effect actually is tied with year T+1 or year T+2. And if you really want to capture the industry contagion effect, you should use industry by year fixed effect for the year that you try to predict the impairment. So it will be industry by year T+1 or
Okay,
T+N.
Okay, so potentially like something is happening in the macroeconomy that causes like a bunch of
Yeah.
firms in the industry to impair. Okay.
Yeah.
Okay, we can
Yeah.
try. Yeah, we can try using the fixed effects that are matched with the future period.
Yeah.
Okay, thanks. Okay, so when we look at the triple interaction, including the variables for strong monitoring, we find that the combined coefficient on all of these variables is not statistically different from 0, except for in one column. And so essentially strong monitoring mitigates this strategic reliance almost entirely. And so while this cross-section of firm years with both incentive and opportunity to delay impairment is small, we do a back of the envelope calculation and estimate that it still delays an economically significant amount of goodwill impairments in our sample. Okay, so next we sort of switch gears and look at it how investors perceive reliance on the qualitative assessment when the quantitative.
One more question, I apologize.
No, go ahead.
You looked at, as one of your variables, you used the loss in year T. How about trying to use some kind of a future bankruptcy prediction to classify firms into those that would have more of a chance to go bankrupt versus others that are more solid?
Are you worried that if they go bankrupt, then their impairments wouldn't even show up because they would just drop out?
No,
is
it's just you're looking here at two things. You're looking at the probability that you would have an impairment. And the probability would go up the more uncertain are the future cash flows, which would also lead potentially to bankruptcy. And that's some of the things that bankruptcy models would capture. The other thing is managers who are closer to bankruptcy would typically have more of an incentive to not record goodwill impairment. So pass the test this year and delay as much as possible.
Okay. Okay, so
instead of the loss, or in addition to that, maybe some kind of a probability of bankruptcy as you capture through an Altman Z or some of the other measures that give you a probability of bankruptcy.
Okay, yeah, we can think about that. We do include some things like that we talked about for the future periods, like their acquisition intensity and their recent impairments. So trying to get at kind of this similar idea of like how at risk they are, some of those control variables, but we haven't looked, we can look more specifically at like a probability of bankruptcy measure like that, yeah.
In year T.
In year T.
Yeah.
Okay. Okay. So yes, I should say that I should clarify that when I said that we have included those variables, we've included them in year T. So we just talked about them in terms of looking at them in terms of the future periods. But yeah, now we're talking about year T controls. Okay. So in terms of investors' perceptions of reliance on one method or another, we think about this in terms of their expectations for future impairments. So if investors perceive that reliance on the qualitative assessment is credible, even when it looks like based on this one indicator, managers should be doing the quantitative test, then investors would expect that the likelihood of future impairment is low. If it looks like, if investors expect that reliance on the qualitative assessment is strategic when they should be doing a quantitative test, then their expectations would be that there will be a higher likelihood of future impairment. Okay? So our H2 is stated in the null here, that their expectations of future impairments don't depend on the current year testing method. So to test this, we look at the market reaction to unexpected impairments in T+1. Okay, so we regress the earnings announcement return on an unexpected impairment indicator, which is equal to 1 if the actual impairment that's recognized in T+1 is greater than the expected impairment in T+1. And for the expected impairment, we follow prior literature and measure it based on the difference between the amount by which book value of equity exceeds market value of equity. Okay, and we control for the rest of the earnings surprise here, since this is at the earnings announcement. Yeah, I am.
So this is a typical kind of ERC kind of specification, despite that you use a dummy variable instead of a continuous dollar amount. What's your motivation for using a binary variable instead of just a impaired amount? Or the lack of it?
I think we like the indicator variable because it makes it easier to interpret the result. So it's just some percentage by which they penalize these firms differently.
But
when
you
they
kind
have
of like are going to assume either you impair $1 versus $1 billion, they kind of are the same, or you're averaging out. That's kind of like this whole ERC. And it's like per dollar of the earnings, what's the market reaction? But here you are like, whether you have impairment or not, or whether you report earnings. I think that is a little disconnect with the literature, right?
Okay, yeah, we can try the continuous variable. I mean, we certainly have it. It's the underlying variable. Yeah. Okay. Okay, so our coefficient of interest here is beta 4, so the coefficient on this interaction term, and we expect that if investors are more negatively surprised after firms just relied on the qualitative test, that this coefficient is negative, and if investors are less surprised after they just relied on the qualitative assessment because they knew it was going to be strategic, then this coefficient would be positive. And what we find
I apologize, but the market reaction is over what period?
The market reaction is in the following year when they recognize the impairment.
No, but what is the window that you look at?
Oh, it's the 3-day earnings announcement return.
So the problem with that is not all firms would provide you with information about impairments in the earnings release. It could very well be that it would be delayed to the 10Q, which would come subsequently.
Okay. Yeah, I think that for the most part, there are at the time of the earnings announcement now, there are at least the financial statements that are included in there, but it is possible that there aren't that there's an impairment that is not discussed that we wouldn't find out about until the footnotes. I think at some point we had looked at whether we could include a robustness test for the concurrent filers to make sure that the 10K was within that same window. I'm not sure if it's still within this current version of the paper, but that's something that we can look at. Okay. Okay, so these results are in our table 7, and we find that the coefficient on the interaction term is negative. So how we interpret this is that investors react more negatively to a future impairment when managers relied on the qualitative assessment this year. So this is consistent with them viewing reliance on the qualitative assessment as a credible signal that the firm is far away from impairment. And we do this within the firm years in which managers had both incentive to delay and weak monitoring when they relied on the qualitative assessment, and this effect persists. So even under those conditions, investors appear to think that reliance on the qualitative assessment is consistent with managers' private information. So next year, when they recognize impairments, then they're more surprised. Okay, so far for the 50 minutes that we've been going, we've been talking about reliance on the qualitative assessment when a quantitative test appears necessary. And in the last part of the paper, we switched to looking at reliance on the quantitative test when a qualitative assessment appears sufficient. So even when there is a market value cushion, most firms still rely on the quantitative test. And there's two reasons for this. The first reason we already talked about earlier, that even when firms use the qualitative assessment, they still sometimes use the quantitative assessment. Okay, so they're not using it all the time. And a lot of firms even have a policy, which this one appears in their disclosure for Home Depot, that they'll do a quantitative test at least once every 3 years. The second reason is that there is a group of firms that still always relies on the quantitative test. And we had a chance to talk to some of these companies, and they basically said, like, why fix something that isn't broken? We have a process for this, and our CEO likes that process. Okay? So we kind of dig into this second group. So this second group makes up about 16% of firms in our sample, and they exclusively rely on the quantitative test. So we look at who these firms are. And then given that the whole point of introducing the qualitative test was to reduce the cost and complexity of impairment testing, we look at whether these firms incur any additional compliance costs by just sticking with the quantitative test. And then they could also experience some benefit from this. So we also look at whether they experience some benefit from sticking with a quantitative test. So who are these firms? We find that these are larger firms that exclusively rely on the quantitative test, and they have more reporting units. We thought this was a really interesting result because based on our conversations with practitioners, the quantitative test is easier to perform when goodwill from different acquisitions is tracked in individual reporting units, sort of more granularly, as opposed to when goodwill from a bunch of acquisitions is lumped together. Okay. So this could indicate that the quantitative test is less costly for these firms. We also find that these firms have older and longer tenured CEOs, and they tend to produce high quality reporting. So they have fewer past restatements and material weaknesses. So these firms have leaders that could potentially just prefer a more rigorous reporting process. To see whether they incur any additional compliance costs because of this choice, we look at their audit fees and the time to file their financial statements, and we find no evidence that they incur higher audit fees or take longer to file than firms that sometimes use the qualitative assessment. And then lastly, we look at whether these firms have some reputational benefit from sticking with a quantitative test. But we also do not find that investors perceive their earnings to be more informative. So this is not to say that the qualitative assessment hasn't provided cost savings across the board, but there is a group of firms for which it doesn't really make sense to incur the switching costs to adopt the qualitative option. Okay, so what do we hope people take away from our paper, and particularly thinking about accounting design with the theme of this workshop? First is that when incentives and opportunity align, some managers exploit the qualitative assessment to delay impairment. On average, though, most firms appear to use the qualitative assessment how the FASB intended, when the information that they have indicates that they're far away from impairment. Second is that investors appear to view reliance on the qualitative assessment as a signal that an impairment in the future is unlikely, even when it looks like they should be doing the quantitative test. And then lastly, there is a group of firms who still exclusively rely on the quantitative test, and they do not appear to, at least we don't find no evidence that they incur excess reporting costs as a result. So, you know, the size of this group is going to vary depending on which particular accounting standard we're thinking about, but should be taken into consideration when we weigh the costs and benefits. Thank you very much for the questions and comments. We're revising the paper right now, so it's really good timing, and these are really helpful. We have some things to think about. And please tune into the next presentation, which is 2 weeks from today, by Henry Lorien on a cool related paper, when the lack of a goodwill impairment is informative.
Hey, Katie. I stopped recording.